Turo is the world's largest car sharing marketplace, and it's the perfect app for travel.
I was recently traveling overseas for 7 weeks in multiple cities. Turo made it so easy to find the type of car that I needed in each city, including various things like a car seat, snow tires, and a lot of space.
I live in SF, Austin, and Sydney, and I use their cars wherever I am and when I'm traveling. I don't have a car in SF and Austin, and we just use Turo. The booking process is so convenient, and the hosts are awesome. Go to Turo.com and download the app today.
Are you building a SaaS business and looking to achieve compliance with SOC 2 and ISO 27001 or other security and privacy frameworks?
Compliance can unlock major growth and build essential customer trust, but let's face it, it's usually time-consuming and expensive.
And really kind of a pain. That's where Vanta comes in. Vanta automates up to 90% of customer compliance tasks, making you audit ready fast and saving you up to 85% of the associated costs. Plus, Vanta scales with your business, offering a market-leading trust management platform to continuously monitor compliance, unify risk management, and streamline security reviews. Join 7,000 global companies, including Atlassian and Dovetail, that trust Vanta to build and prove their security in real time.
And for our listeners, Vanta is offering 10% off.
Just go to vanta.com/first. That's VANTA.com/first.
Okay, 3, 2, 1. Hey, I'm Cheryl.
I'm Maxine.
This is First Check, part of Day One, the network dedicated to founders, operators, and investors.
If you want to be a better early stage investor, this is the show for you.
So TLDR, if you don't want to suck at investing, listen up. We have another ex-investment banker coming on the show today. And I have a question, because we seem to have a lot of ex-investment bankers in the VC space. And I don't know a lot about what they do, but it seems to me I've heard that they make a lot of money. So I'm wondering, why in the world would anyone go from I do all this stuff at a really high level and make lots of money to, hey, I'm going to go into VC where the long tail of making money is very far away and the feedback loop is just absolutely brutal. Do you have any idea?
I don't know. It's more fun, it's more interesting, you work closer with the founders. But I don't know, we should ask her.
We should.
I mean, I think Christina is one of those people who is deeply thoughtful about the stuff that she does. And I am confident she thought a lot about why to make the move. So I'm really excited to see what she thinks. We'll spring it on her.
Excellent. I need to have all of my burning questions answered about investment bankers and why they moved to VC.
Right. But I'm so excited to have her on the podcast today. So we've got Christina Fa from NewView Capital. She is a growth stage investor based out of San Francisco, but invests globally. So she has this really interesting perspective across ecosystems and also across stages because she has to cover them all to be a great growth investor. I mean, you and I are early stage investors, and I wouldn't say I'm particularly knowledgeable about growth stage. So excited to get a primer here from one of the best growth stage investors.
Yeah. What is growth stage?
What does that even mean? What is growth as a concept?
What is that?
So yeah, excited to have her on. She also has a really interesting perspective on secondaries. NewView does a very interesting secondary strategy, and this is a strategy that's popped up a lot over the last 2 years where companies were struggling, early stage investors and also early stage employees, and sometimes even founders were looking to liquidity off the table. So excited to dive in with her there and just kind of pick her brain about what she's seeing up there in growth to get us a good perspective across what's happening.
We can ask her how the weather is up there. Hello, how's the weather in the stratosphere? I think the secondaries angle is actually really interesting because we have such a nascent secondaries market in Australia, and it's actually been the talk, probably the number one thing that I hear all the time recently from VCs across the board, because of the whole kind of liquidity crunch and how do we get exits and how do we find liquidity in this market. We just don't have the right answers. I don't know if that's because the structures that we use or we haven't had that much demand, but I think it's something that's going to change a lot, a huge drastic change in the next 3 to 5 years.
100%. Yeah. I can't wait to have her on.
Get into it.
So excited to have Christina Fa here from NewView. I have been really looking forward to this conversation for ages. My wonderful conversations with Christina in the past, I just feel like I come away educated, especially on growth and especially on secondaries every single time. So excited to dive in and nerd out with you on those. But the question we ask everyone before we kick off is, what's the first thing you ever invested in?
This is a bit of a cop-out answer. I think the first thing that I or my family ever really invested in collectively is probably the education of me and my sisters. I think for any immigrant family, education is always such a big focus area. And so my family is no different. What it taught me wasn't so much the content, right? Like I've never had to do calculus a single day in my life in the real world, but I think it teaches you the value of hard work ethic, grit, focus, resilience, time management, right? All things that are very, very important in the world of investing.
Absolutely. I actually have been thinking about this recently, but the value of a lot of like meta skills that you learn, both studying hard subjects at university, but also the kind of early career. I saw you were obviously an investment banker early on in your career. And actually, like, sure, there's lots of tactical skills you learn there, but there's lots of meta skills you learn that I think are crucially important for success later on. Like, one, how to grind. Two, like how to manage upwards.
How to work with difficult people.
Right, yeah. How to manage people yelling at you, etc. But when you think about your education, like there's obviously the content, right, that you learned. But what jumps out to you as the most important skills you learned in education that have been most useful that you still use today?
I think sticking to the task, irrespective of how hard it is, investing similarly to learning something new is you're constantly learning about new things, whether it's a new area of focus, a new trend, a new business model, a new sector. I think you really reap a lot of rewards when you get to that like aha moment. It happens in math, happens in physics, happens when you're learning about a new company. There's like this like aha moment that like ticks through, and I think it's such a rewarding feeling to have when you've done the hard thing and you've like stuck to your guns for a long time.
Yeah, I think that's a really important skill to have. One of the things that maybe fed into your education, and we were just talking about this, Maxine and I, is you went in and became an investment banker before becoming a VC. And I've noticed that there's a lot of ex-investment bankers in the VC world. Well, why do you think that is, and what made you make the jump?
I think it happens more at the growth stage. So you won't see it quite as often in like early seed stage investing. I think the reason is because look, at the growth stage, the type of diligence that we do is probably a little bit different to the diligence that you would do at an early seed stage, angel stage check, right? We're often looking at financials, and I think building out that foundation around understanding the P&L statement of a company, knowing how to navigate Excel, knowing how to dig through a data room, all of those are skill sets that you sort of pick up and you learn along the way. And so investment banking is a great foundation for you to pick that up and learn it.
P&L, crazy. Are you sure you're not using those calculus skills?
Addition and subtraction only.
Oh, right. Okay, so third grade, got it.
I mean, I feel like investment banking, absolutely, the skills are transferable. One of the things that Cheryl and I was saying, like in Australia, first of all, the base rate of lawyers in the Australian population is like outrageously high. And I think kind of translated into the VC space, both early and late stage, there's a way overrepresentation of former lawyers. And that makes sense to me, right? Because law for most people is like fairly boring, pretty grind oriented. So it makes sense to me that lawyers would want to go and do something like VC. It's much more fast paced. It's much more interesting. It's much more human. But as an investment banker, like, yeah, you've got the skills, but why actually make the move? Like, why does VC actually attract investment bankers to a greater degree?
And don't you make less money?
This honestly probably depends on like what level you're making that move over. In investment banking, if you think about your day-to-day job, or like at least my role at the time, it was in the M&A team or the general industrials team or a coverage team. What that means is you are generally helping companies navigate a merger and acquisition or an event where they're like going public, right? A private company IPOing. Now, I think what investment banking teaches you is process management, and you understand what does it mean and what do you need to go through? How do you value a company during one of these transactions? And like valuation is a key skill that you learn during your investment banking days. But like what you're doing in banking at the time is really like a lot of understanding and managing that process on behalf of your client. What you don't get to do is you don't really get to see, or like after the process is finished and the transaction's closed, you don't really have that ongoing relationship with your client again, right? Until they want to do another big transaction. You don't necessarily know how a company is run, reasons why a lot of bankers move into investing is because hey, I understand this is a great company. I got really excited about it. I really believe in the problem that they're solving. And so how do I maintain that long ongoing relationship with them? How do I actually invest in this company? How do I put my money where my mouth is, right? I think if you are a banker, you're often pitching and you're saying, hey, I think this is a great company. You should buy them. And if you really believe it, then you should do it. But like banking doesn't really give you that opportunity to do so. What it does teach you is your ability to navigate and understand financial statements of a company. Investing then allows you to make that decision and, you know, have conviction in your decision.
Makes sense. That's actually really cool.
Oh, that makes sense.
So maybe that kind of begs the question, like, what exactly is growth VC or growth stage?
Yeah, we'd love a 101 primer on growth stage investing. Like, where does it start? What is it? Why does it exist? What's the role that it plays in the progression of a company and as investors? Take us back to brass tacks.
We should probably call out the different purposes of why we even segment early versus growth stage capital. Like what is that distinction? The purpose of early stage venture capital is to invest in early ideas, early teams, early people who are probably still like experimenting and they're playing around to see if there's something here that might work, right? Growth capital, on the other hand, by contrast, the capital is there to enable the products and ideas that have been proven to work. And it's about, how do I build this now into a large company? So the question at this point becomes, how do I scale this? And then also from there, like it's how do I win? How do I dominate this market? I think there's a very natural tendency for winner takes all, or, you know, winner takes most dynamics in technology and software. And that's really where growth stage capital comes in. The general consensus of like where growth starts and where like early stage ends is it's probably somewhere around like Series B, Series C, but like broadly think of it as when a company has found product market fit and they are ready to scale.
Super interesting. My mental model had always been that kind of Series A is the point at which you've like found product market fit. And actually I think it's a dominant perspective in Australia, right? Like Series A is the point at which you found product market fit sufficient to like start thinking about building the company around it. Has that shifted over time? Is my definition off base?
Spoken like a true early stage investor.
Yeah. Let's define it. Like, what does product market fit mean?
Great.
The way that I think about it is you've built a product that customers want to buy, right, at a price and at a margin structure that enables a sustainable business longer term. That's part one. Like part two is you found these customers, they stay and they retain long enough for you to like make back your CAC and ideally and then some, right? And now if you can prove both these points, what you then really need is capital to pour gas on the fire. And you want to scale that like customer acquisition motion again and again and again. And then you do that enough times, it's repeatable, and then you can build a big company coming out of that. I agree with you that there's traditionally been a notion that product market fit is found at Series A. But like these days, like what you want to call your fundraise round is all kind of alphabet soup. More and more often, I see it at Series B. It is potentially because we had a lot of craziness in 2020 and 2021, right? And so I think that seed to A graduation rate potentially was higher than what we would have seen historically. When we think about product market fit as growth stage investors, like that's what we're doing diligence on, and that's what we're trying to prove to justify, does this company need more capital to grow and scale?
So interesting. Yeah, I agree. I think it's like we seem to have just like moved down a noun, but the de-risking point still seems to be the same. Somewhere between kind of 2021 and 2023, it seems to have shifted. And so it ends up being kind of pre-seed, seed, and like in some cases, Series A starts to all be like narrative progression to product market fit stage. And then now kind of like between Series A and Series B is like you found product market fit, you found a repeatable motion. We understand the mechanism of growth here, so we're ready to pour capital on that mechanism of growth and think about horizontal expansion or like expansion of product. So what does that mean in terms of the size of the Series B, like on the bottom end? What for growth capital, like what is the average size of checks that are being written or like investments that are being made at those stages? And what are the kind of traction points that on average you're seeing at that stage?
On average, like I can tell you, like historically, like Series B generally looked like a company that was getting to like 5 to 10 million of run rate revenue, and that's sort of about when growth stage investors are saying, hey, it kind of looks like you're able to demonstrate and prove product market fit now. That threshold came down a lot during the craziness of 2020 and 2021. And so instead of 5 to 10, that looked more like 1 to 5. And then in terms of round size, I would say like average Series A round is probably around like 10, 15 million. And so the average Series B round is probably somewhere around like, call it 20 to 30 million on average.
Super interesting. Yeah. It's amazing, isn't it? Just as a side note, how quickly stuff changes in our industry. Or maybe I've just lost track of the space-time continuum, but like 4 years is, not, if I think about kind of the progression of time we're talking about here, right? Like 2020 to today, 4 years in the grand scheme of things is a very short period of time, but a lot of these metrics have moved quite significantly over that period of time.
Totally.
And having to kind of get a sense of where stuff is moving and how it's contracting back. And also like the founders, right? We're in this all day. Like we're transacting day in, day out in this marketplace. But for a lot of the founders, they're transacting like one time in that period of time.
Mm-hmm. Mm-hmm.
Yeah, the poor founders. They're like, hey, but I heard the metric was this. It's like, no, that was yesterday's metric. Like now it's this. Like anecdotally, the metric I heard all the time was you have to get to 1 million ARR in order to do your Series A. But that's changed, right? The thing that like a lot of founders, I still hear them saying like, oh yeah, we're trying to get to 1 mil ARR so we do our Series A. I'm like, oh, I'm sorry. Thanks for playing.
Interesting. What do you guys see in Australia? Like, do the numbers that I mentioned, does that translate to the Australian ecosystem? Is that consistent?
My experience, no. My experience has been that in the Australian ecosystem, I don't do a lot of Series A and almost no Series B. I get to, my only vantage point is like companies I've invested in going through those.
Yep.
So based on the anecdotes I hear from investors and like the guidance I hear investors giving companies, the range I hear from them is, hey, we want to see somewhere between 2 and 5 mil ARR AUD before we're willing to do a Series A.
Really? Oh, okay. Interesting.
Yeah, which has been super interesting.
Yeah.
But then like we all know there's kind of like a range there, right? Like that's the guidance they give, and then they do a Series A with 100K ARR for the right kind of company. So there's like the rule and then all of the exceptions.
Yep. Yep.
What have you seen, Cheryl?
Yeah, the guidance I hear most often is now the 2 mil ARR mark for Series A. That, but again, it has so many exceptions, right? And I think Australia is doing a lot more like deep tech and med tech and climate tech, where like those types of numbers just go out the window. So like on average, you're not seeing quite like a concentration. I think we're seeing a lot more of like a range between like 200K and 5 mil here. One of the things that I think is interesting is the narrative around how the later stage valuations have been more impacted by the last like 6 to 12 months. Like, is that something that you're seeing at your stage?
Definitely. I think we have to remember that like during the ZERP era, there was a lot of capital that flowed into the private venture ecosystem as a whole, right? And it started, I would say, actually more at the later stage. And so when you have a ballooning supply of capital in the ecosystem, macroeconomics 101, like what that means is prices go up. That definitely happened in the growth stage first. I would say now we have returned back to a much more normalized state. And typically what you'll see is private market valuations will generally follow where public market valuations are. I think public market valuations also ballooned during the ZERP era. And nowadays, if you look at public companies today, you don't really see very many companies that are growing much more beyond 30% year on year. I would say the very highest performing SaaS companies today probably trade somewhere between 10 and 20 times next 12 months revenue.
What are you calling it? ZERP era?
The zero interest rate phenomenon. Maybe that abbreviation hasn't quite caught on in Australia yet. Yeah,
no, Maxine, have you heard that?
No, that's my first time.
Zero interest rate phenomena.
It's growth stage jargon coming down to the early stage.
ZERP. Okay. Calling it the ZERP era. So wait, what is the ZERP era? Is it the entire time where there was a zero interest rate?
Exactly.
Learned a new word today.
Are you building a SaaS business and looking to achieve compliance with SOC 2 and ISO 27001 or other security and privacy frameworks?
Compliance can unlock major growth and build essential customer trust, but let's face it, it's usually time consuming and expensive.
And really kind of a pain. That's where Vanta comes in. Vanta automates up to 90% of customer compliance tasks, making you audit ready fast and saving you up to 85% of the associated costs. Plus, Vanta scales with your business, offering a market-leading trust management platform to continuously monitor compliance, unify risk management, and streamline security reviews. Join 7,000 global companies, including Atlassian and Dovetail, that trust Vanta to build and prove their security in real time.
And for our listeners, Vanta is offering 10% off.
Just go to vanta.com/first. That's VANTA.com/first.
So how is it now, right? Like with the market contraction, obviously during the ZERP era, or on the other side of the ZERP era, and that kind of moving through to the growth stage, there's obviously been an increase in activity in the markets. While IPOs haven't sped up, we have had kind of a few start to move through. Sentiment seems to be rebuilding. So what's happening at growth stage? Are you seeing an increase in activity? Is it stayed stable? Like what's happening to valuations?
Yeah. If you had asked me 12 months ago, I would have told you it's still very quiet. Things have definitely picked up in the last 6 months or so. I would say AI is a big driver of that. If you have an AI story, and this is the same thing with public market companies as well, a lot of investor attention. Growth activity is starting to come back. We should never really expect it to get ever back to the 2020, 2021 crazy era. That was a very super unhealthy, unsustainable time. Valuations aren't getting back to those points either. We're just restabilizing, right? Back to call it 2017, 2018. I don't think we're quite there yet even. I think we're still below that. But there are definitely sort of early green shoots of activity. Investors are definitely deploying capital. We're seeing some really exciting companies. And so, yeah, things are coming back, which is nice.
I like that. Green shoots seems to be a theme.
Yeah, for sure. It's interesting. I remember kind of early 2023, maybe late 22, I heard Bill Gurley talking about some research that Benchmark did on the previous cycles of kind of risk appetite in the market. And, what seems to happen in venture historically had been, risk appetite, i.e. valuations, round size, etc. The level of traction people are looking for, all of those features build slowly over time. And then they come off really quickly. And then they build slowly over time and they come off really quickly. So kind of I'm proceeding on the assumption that it builds slowly over time. I'm interested this time around, though, whether that will be true, because there's so much more understanding of venture as a space, right? In the last couple of cycles, venture was much more of a cottage industry, and now it's a much bigger industry. Because of that, because of the maturity of the market, I feel like we're better at assessing and understanding the opportunity in venture. So I'm intrigued to see the pace at which that appetite rebuilds this cycle and the risk rebuilds. What do you think?
Yeah, I think this cycle, the recovery is happening simultaneously in conjunction with a big platform shift. So I think the speed is going back a little bit faster. We see some pretty spicy valuations here and there, and everyone's just like, wow, we are so back. And I think when there is a huge platform shift and with the GenAI innovation that's happening in the market right now, when that happens, investors get naturally very excited. We're all looking at the OpenAI demo days, the Google Gemini demo days, and we're seeing wow, in a few years' time, the way that we interact with software is going to be fundamentally so different to how we have interacted with software in the past. Instead of going to a website, reading everything in the website, synthesizing it yourself, you'll just ask a chatbot who will give you the right information at the right time. Isn't that crazy? How insane is that? And so I think when we see such a crazy platform shift occur, and that this technology has now gotten to a point where we can build a very different way in terms of how we interact with software in the future, I think that gets people very excited. And naturally that means you're going to see a lot more capital and a lot more interesting developments in this space. And so the recovery in venture and tech is coinciding with this huge platform shift right now. And so I think that recovery is going to be a little bit faster than what we've seen in historical trends.
Nice. That's what we want to hear.
So what are you seeing at the moment in terms of like what kinds of deals are getting done really quickly, like hot deals? What are folks getting super excited about? I mean, obviously, I think GenAI is part of that, as you mentioned, right? Like it feels like a consensus view that like the LLMs and AI is a massive platform shift. And so people are kind of heavily investing there. But what kind of companies are you seeing as being really hot? What are the features of them?
I think GenAI is a platform shift, but the types of companies that we as growth stage investors continue to be excited about is like, does this company demonstrate really impressive product market fit? And it still comes back down to that. Usually what that means is high growth, but right now we also really value efficient growth. The third leg to the stool is, do we think that this company is extremely defensible? What they are building today, do we think that this will persist for some period of time such that we can build a very large, durable, sustainable company on the back of this? And I think that is a question mark at the moment with a lot of the really exciting companies that we see in the Gen AI space. It's obviously a very exciting space to be investing in. It's also a really difficult space to be investing in, right? I think about this in the framework of like exploration versus exploitation. Exploration being, hey, there's still so much more new innovation that's still to come out. We're not at the point where we can exploit this to build something that has core defensibility. There's that push and pull between the two if you're investing in the AI space at the moment.
It is, you're right. It's like so exciting and so hard because it is such high pace and so much change. I really like that framework.
And we're still so early in the cycle for this technology, right? Everyone is still experimenting and figuring it out and working out what it can do, what it can't do. What are the possibilities? Just the number of things that I think are coming out still. We still have so far to go. One of the things that I think we are really interested in, because where we play, there just isn't a ton of like liquidity and secondary opportunities. But I understand that's something that you play a decent amount in. So how do you think about secondary investments at NewView?
Is it helpful to walk through what secondary investing is? Like the difference between primary and secondary?
Oh, yes.
That actually probably is a great, you're even better at this than we are. We're like,
yeah, loving the definitional piece.
Good. Okay, so primary investing, it means you're issuing new shares, like brand new shares that did not previously exist. So think a company raises a seed round, they're getting new capital, right, injected into the company. And then in return, investors get equity ownership. And so all the existing investors will lose a little bit of ownership in that process, and that's called dilution. In secondary investing, there's actually no new capital injection into the company, right? So it means an existing shareholder is going to sell their ownership in the company to another investor. So that's what we call secondary investing. So, but like, why would someone sell their ownership in a company? I think if you think about like venture as an ecosystem, it's relatively nascent. It's gone through a lot of change. But like once upon a time, companies were founded and then they IPO'd very, very quickly. If you look at like Amazon, Google, Facebook, I think all three of them IPO'd within like 4 to 8 years post-founding. Now, the average venture fund life is 10 years usually. And so 4 to 8 years of exits, 10-year fund life cycle, that timing works well. That's just not really the case anymore. There's just like so much more private capital at the growth stages now. And so the requirements for size and scale are pretty high, right? To be able to, I don't know about the ASX, but in the US, if you look at the NASDAQ, I think a lot of public market investors are really saying, hey, you need to be at $250 million of revenue, right? Some people say it's more like 500. Otherwise, you'll struggle to get sufficient analyst coverage. Otherwise, you'll struggle to get enough investor interest. And so all this means companies will be private for a really, really long period of time. Now, what that means is you'll have a bunch of investors who will have their money stuck in a company for a really, really long time until that company actually has an exit or liquidity event. Now, the way to get around that is basically secondary markets or secondary investing. Historically, not a large trend in the venture ecosystem because everyone's like, well, I want to hold on to my winners for a really long time. I really believe in this company. If you look at the companies that are staying private for a really long time, you end up with a lot of capital that is locked in, and there's not a lot of liquidity for early investors, early angel investors, founders or their employees. If you look at venture capital and you compare it to private equity, which is a much more mature asset class, in venture capital, I think it's like 0.3% of total AUM trades hands every year via secondaries transactions. Now, in private equity, that number is 2% every year. So it's an order of magnitude larger. And I think as IPO markets continue, to be pretty muted, M&A is also a little bit muted at the moment. There's just not a lot of opportunities for GPs or investors to achieve any DPI by these traditional routes. And so secondaries, as a result, has been a much bigger topic in the last 12 to 24 months.
That was so good. What a great primer. I think that should just go in the definition of primers for secondaries. For the folks in the back, this is what a secondary is.
Yeah.
I love it.
Just pull that as a snippet.
Yeah. So the question that comes to my mind, like in 2018, 2019, the kind of sentiment was all capital invested. We want this to go into the company, to grow the company, as opposed to going to earlier investors. I feel like that shifted in 2020 and 2021 because, there were such hot rounds and people were just trying to get positions into these organizations. What is the prevailing sentiment you guys get to see when you are putting secondaries on the table? How are investors coming in and existing investors thinking about secondaries, both for early stage investors, early employees, and maybe even some founders?
Look, I think right now there's much higher receptivity, right? The reason for that, depending on which profile of person you're talking to, can differ. So for a lot of GPs, Canva is a great example, right? There was the Canva secondary that happened very recently. A lot of these early investors have been investors in Canva for a really long time. I think the question at that point is, hey, when am I ever going to get liquidity in this name? I think for a lot of GPs, they also need to bridge the TVPI to DPI gap. Do I need to go through what TVPI, DPI is? Is that helpful or?
I love the definition. No, I think we've actually defined it previously.
Right, okay.
But just as a reminder, TVPI is essentially your on paper value increase, and DPI is the money actually distributed back to investors.
Exactly. Now, at the end of the day, TVPI isn't yet real, right? DPI is what is true and what you can take home to the bank. And for a really long time, a lot of venture investors had great TVPIs, but they couldn't really convert that into DPI. Now, if you don't convert it into DPI, you don't return that capital back to your LPs. That means your LPs don't have capital to put into your next fund. And so that becomes this big circular loop, and there's a bit of a bottleneck because companies were staying private for such a long time. And so secondaries helps to unlock that bottleneck, right? So it's very healthy and it's very helpful for the GP and the LP ecosystem. Now, if it's for a founder, we want our founders to be incentivized to work hard and they have a lot of ownership in the company, but they're also people, right? They also have families. They have commitments, they have personal commitments to friends and family, their children. Look, we want them to continue to be economically incentivized to build the company, as much value as they can. But we also want them to not be worried about their personal financial situation. And so I think having founders take some liquidity off the table is a good thing. Early angel investors, another great example, you back this company when it was really just a team, and your specialty is really backing these early teams with early ideas. But if you don't get that money back, you don't get to reinvest in the next generation of founders. And so overall, I think unlocking liquidity here is net beneficial for the ecosystem as a whole.
I mean, I think as an angel, that makes total sense to me. I want money back at some point in the next 5 to 10 years so I can keep investing. The whole name of the game and angel investors don't run out of money. My question is, why buy secondaries? Hasn't the company experienced the biggest portion of growth that they're going to experience in that time, and you're coming in at the end when they're going to grow a little bit and you're still kind of taking on a good chunk of risk? To me, buying secondaries makes zero sense. Who bought all of that Canva secondaries thinking they're going to go are they going to double their valuation again?
Such a spicy opinion.
It's a great question. I think it depends on the investor underwriting profile. There's no such thing necessarily as a bad investment. I think it just depends on what your investment mandate is. There are some public market investors care about IRR. That's the measure of return that they really care about. Venture investors historically care more about MOM. And that's the metric that they've always indexed success to.
I don't know that one.
MOM is just MOIC.
money on invested capital.
Yeah,
Right. Okay. Like how much you give me back versus how much I gave you.
exactly. IRR is just money on money, but you take into account what time period that increase happened over.
Yeah. Got it. Sorry, carry on.
The way that we think about secondary investing at NewView, I should probably caveat, is not really any different to how we think about primary investing, right? It's just another way for us to get on the cap table. So if I would invest in this company right now as call it a net new Series D investment, if I'm willing to do primary in this company, then I should also be willing to do secondary in this company as well. It doesn't really matter how you get on the cap table. It's just another method to another tool in the belt.
Super cool. I know there's been a lot of innovation and adjustment in the US in particular in like mechanisms on how to buy those secondaries. Obviously, you've had like EquityZen and Forge and a bunch of those folks kind of come into market. I know obviously there is the opportunity to do it actually as part of a transaction. I mean, I'm assuming that NewView does them as part of transactions. They don't do them out of cycle. Is that true? Or do you sometimes seek to do secondary transactions kind of not as part of a existing transaction and try to catalyze a transaction to do a secondary?
Honestly, it varies. So there's different secondary transactions. One particular type of secondary transaction is called a tender offer. And a tender offer, at least this is in the US context, but a tender offer is basically a broad solicitation to all the shareholders on the cap table. I want to buy your shares at this particular price. This is the deadline at which point the process stops. Tell me before the deadline if you would like to participate. Now, the company obviously needs to engage in that process, right? Because you're reaching out to all of their shareholders. That can be, a relatively long process. You need to get the lawyers involved. There are also one-off secondary transactions. And so that might just mean you're transacting with one particular seller or a handful of sellers, but you're not doing a broad solicitation to every single shareholder that's on the cap table. And, those transactions are very easy and quite simple, actually are very sort of low overhead transactions to manage.
Oh, cool. Because I know Carter got themselves into some hot water trying to do a blended version there of reaching out to investors kind of without engaging the companies. And I know that there was some chat in 2020 of AngelList starting to do it at the syndicate participant level. So it kind of opens the question for me as folks are thinking about growth stage. Obviously, the ticket sizes are bigger, right? The investment sizes that are going into the companies are much bigger, and there's kind of a little more de-risk that's happened at that stage. Do you ever see angel investors participating in growth stage rounds? Or if not, kind of how do individual investors get access to growth stage?
I think we don't see angel investors participate in growth stage rounds very often. And the reason isn't so much that you can't, it's more so just a function of check size, right? So let's say the growth stage round size is anywhere between 20 million to a couple $100 million. If your angel check size is, a couple $100,000, or what is the reason for why the founder is letting you on the cap table at that size? So I think the question is what is your value add, and why do you deserve to invest in this growth round, given you're probably not going to be able to contribute a huge amount of capital? It's not a function of you can't. It's more of a function of, why is the founder letting you in?
That makes sense.
Yeah, makes sense. So assume then that the best way to get exposure to growth stage, if you want it in your portfolio, is actually via a fund, investing in funds that do growth stage investing.
You can do that. I mean, that's you're basically getting exposure to all the investments for that particular fund. You can, I think, if you're an angel investor and you want to invest in growth stage companies, I think AngelList is a good platform to do it. There are some secondary platforms where you can invest in secondary transactions in specific growth stage companies as well. I think the question for you then is just do you have enough data and enough information to make that investment decision, right? I think when you're investing at the very early, seed and angel stage, you're probably meeting with management, probably spending time with them, you're getting to know them, you're, falling in love with the idea and the problem that they're solving. You probably won't get that kind of exposure at the later stage. And so what data, what information do you actually have to justify whether or not this investment is a good investment? And that diligence process at later stage is very different.
Yeah, makes sense. So you've had this incredible career so far that spanned 3 geos. right? You are Australian, as you can tell by the accent, and have exposure here, but also have worked in the UK and then also now in the Bay Area where you live. So what have you noticed about the differences across each of those ecosystems, especially, at the growth stage and in the secondary market? What's been your observation?
Look, at the growth stage, a lot of differences between these markets as a whole. I think there's a difference between how you scale companies, I think, in these different geos. What I will say about the difference between company scaling in the US versus that of Australia is, like, the US is a much more mature ecosystem. There's a very deep pool of talent. And so you can find people who have really, really specific domain expertise. So, like, let's say hypothetically, you're hiring a chief product officer who has scaled a PLG company from 10 million to 100 million and knows data infrastructure really well, right? And also has, let's call it, experience in M&A. Like, great. In the US, we probably have like 50 to 100 people who fit that bill specifically. Not really the case in Australia. It's harder to find people who have done that scaling journey before. Like, what Australia has is a pool of people who are very hungry, very smart, very talented, but they're probably approaching a lot of these things and a lot of problems from first principles. If you're building a company that is, going to remain headquartered in Australia, I would probably strongly suggest getting like a very high quality bench of advisors who can educate and give guidance and advice to your various like functional leaders. And so you can tap into the experience of people who have seen and done that fast scaling journey before. When I look at the Aussie ecosystem right now, it's funny, when I was at Atomico, my prior venture role, I was actually in charge of covering the Nordics and the Baltics. Once I got to know the Australian tech ecosystem, I saw a lot of similarities between the two, right? Like a very highly educated populace. And within each of these countries, I would say they've had like a few examples of really great outside success. In Sweden, they have Klarna. They also had Spotify. In Denmark, they had Zendesk as an example. And so they had seen a couple of these examples of like really outsized large tech outcomes. And you could see, people who had gone through the ranks go on then to start their own venture funds or go on to become angel investors to support the next generation and the next generation of that ecosystem. And I think we're starting to see that in Australia, and like, that's great. That's really lovely to see. And I'm really, really excited about the Australian tech ecosystem getting bigger and flourishing.
So excited for that. And it's happening. Like, the movement that we've seen over the last 6 years is crazy. And I think it's only accelerating. So the last question that we ask all of our guests on our show is, what is your big cojones moment?
Where did you guys get big cojones from?
Where did I forget now?
Where is that?
It's such a funny word, but it was our very first podcast guest, who I now forget who it was. Maxine, do you remember?
Jessie Woo.
Oh, yeah. Yeah.
Jessie laid down the big cojones moment.
Yeah, because she's just like so brave. She's one of the VC investors here in Australia who just like has this really brave voice. We had a great chat with her, and I think she was the one who brought out that word.
Yeah, okay, great. I love it. Okay, so I come from a family of doctors. 3 out of my 4 grandparents are doctors. Both my aunts are in healthcare. And then both my sisters have also ended up in healthcare as well.
Oh, no.
When I was 18, I graduated from high school. And so, like, obviously, I was going to go to med school, managed to get in. Parents were stoked. And then I, at the very last minute, was like, I really actually don't want to be a doctor. So I bailed on med school at the last minute.
Oh.
Had a huge falling out with my parents as a result, so much so that I had to leave home. But we're actually fine now. Like, we have a great relationship now, but it was definitely strained for a couple of years. I didn't speak to them for, I think, almost 2 years, and I also left home. Now, I actually thought at that point that I wanted to be a lawyer. Right. I think you were saying law is very, very boring and it's very dry and it's a grind, which is totally true. But I really thought at that point that I wanted to be a lawyer. And so what I did was I went and emailed a bunch of lawyers, cold emailed them. I reckon I sent out like 50 to 100 emails in the course of 2 weeks. I probably didn't get very many replies back, but I think it was actually like really good practice as a VC associate, right? You send out a lot of cold emails, you don't get a lot of replies. eventually there was one barrister who did reply, and he was like, sure, like come and like be my work experience student for a little bit. So I worked for him for free. He happened to be from my brother's school, and he was also a Queen's Counsel. So he was actually like very well regarded in international arbitration. And so kindly like took me under his wing. I ended up working for him throughout uni as his assistant. Absolutely stoked to have that experience at the time. In the end, I ended up deciding not to do law, which he was not super pleased about.
Oh, no.
So, but regardless, I think the experience taught me you should just like be shameless and ask for help, right? You never know which kind-hearted person is going to respond to you. I think it taught me that you have to have like a willingness to be bold and like take charge of your life and like stick to your guns. And you have to have conviction in yourself and the decisions that you make for your life.
Wow.
100%. And that is such a brave call to be like, hey, family, all of you who are doctors and like medical professionals, actually no, not it.
Not going to be a doctor.
I am going to chase the thing I really want to do. That's so brave.
But also then to do that again.
I know.
Like then you also were like, hey, thanks for taking me under your wing, but also not going to be a lawyer either. So bye.
Yeah, I know.
Cojones on this one.
When I told him that, he bought me this book. It was called The Bonfire of the Vanities. I don't know if you guys have ever read it.
No.
It was a hilarious book to buy someone when they tell you that they are not going to do law and they're going to go into finance, because the book is about this man who is he's like a bond trader, and he has this like incredible fall from grace and his battle with the legal system as a result. Which I love. Such a hilarious book to buy someone who's like, I'm not going to do law, I'm going to do finance.
Well, I think he was just trolling you. He's like, well, all right.
He definitely was trolling me. It was hilarious. It was a good guy.
Oh, man. Well, I'm glad it worked out with the family in the long run, though. They came around. Being in finance is not the worst.
No, they came around. My dad is actually a software engineer. There was a brief stint where I was at Google for 2 years, and he was stoked when I was at Google. He was just like, this is my dream. Like, I love that you get to work at Google.
Aww.
And then obviously he was like not stoked when I left Google again. So
oh, man.
A roller coaster for them.
I know.
This has been such a treat. Thank you so much for jumping on with us and educating us about growth and educating us about secondaries. Amazing. And love all of the definitions. Thanks so much for joining us.
Of course. Thank you so much for having me.
Thanks, Christina.